Hello, welcome back to the channel. So in today's video, I'll be covering my underperforming stocks as well as my TCs for all these different companies. So for reference, this is my portfolio. So I own a number of underperforming stocks and I'll be covering them today. So the first stock that I'll be talking about is actually Google. So Google is still trailing the S&P 500 despite being up nearly 50% since the lows in April. It is currently trading at a 22 times of earnings. So for Google, the TCs are as follows. So first of all, your LLM risk was overstated. So LLM, they make money through subscriptions, whereas Google offers a free platform for users to use. So it is impossible for the LLMs to get consumers to switch over to them because there's high switching costs. You have to pay a subscription to update their service on these LLM platforms. Whereas for Google, there's almost no cost tied to it. And besides that, Google's AI mode is the first AI model that's incorporating ads into its platform, something that other LLMs can't do. So Sam Altman, for example, part of ChatGPT, actually came out and said that he won't be pushing for ads on ChatGPT because it will hurt the consumer experience. It will cause consumers to switch away to other LLMs and even to Google search. So that is a positive development for Google because they're not only able to defend their own share, they are also elevating its earnings through all these AI innovations as well. Besides that, Google's search revenue won't get hit as hard. So Google actually makes a lot of its revenues from these two segments of search. So it will be your commercial search as well as your transactional search. So these two portions actually make up the majority of Google's revenue. So for Google, this means that the 84% that your LLMs are targeting, they won't hurt Google as much. So your return on ad spend for all these different LLMs will probably be a lot lower than Google as well because your LLMs are targeting more of informational search, whereas Google is targeting your transactional as well as your commercial, which is highly profitable for both the advertisers as well as Google. So that was why I thought that Google will be able to defend its own market share. So the next company that I'll be covering as well is ASML. So ASML year to date is up around 9%. It is currently still trailing the S&P 500. So for ASML, there are two tailwinds for the company. So your hyperscalers are spending a lot of money on all the different chips, and the hyperscaler spend will eventually trickle down to ASML. After all, they create the most essential machine in the entire chip making process. So the US is also planning to spend more money on chips and more money on fabs. What they're trying to do is to isolate all the fabs in the US so that the US control the chip production globally. So this is also another tailwind for ASML that will probably lead to more positive developments in the future. So ASML is the highest quality semiconductor company out there with predictable streams of income. That was one of the reasons why I invested into the company. Besides that, the growth fears currently are overstated. So current fears over limited growth in 2026 is something that is industry-wide and not company-specific. So global demand in 2030 will still remain. So whether or not they buy it in 2026, they will still have to eventually buy it by 2030. It's the same argument to be made when it comes to Intel as well as Samsung. So some people are bearish on ASML because Intel and Samsung are reducing their capex spend. So this means that ASML will make less money. But your global demand will still remain. So if Intel and Samsung doesn't fulfill it, then another company will come into the space to fulfill that demand. So that is why I think the fear of no growth is currently one that is overstated for ASML. So for ASML, of course, you have risk with the company. First of all, you have your China risk. So China is spending a lot of money on R&D for your lithography. So Huawei, for example, actually spends 10 times more than ASML. So that is one portion that could hurt ASML's monopoly, especially with the government's backing as well. Besides that, ASML is a company that profits. ASML is a company that benefits from increase in complexity. So they don't necessarily benefit from volume increases. They benefit substantially when your complexity of your chip increases, when your litho intensity increases. So for ASML, unless this AI tailwind continues over the next 10 years, unless we see more and more innovations, unless we see agentic AI coming in, ASML might not be the direct beneficiary of this AI revolution. Besides that, you have of course your supply chain as well as your tariffs. So ASML is a company that is assembling a lot of your different parts into one singular machine. So any supply chain problem will hurt the business. And on top of that, you have the tariffs as well, which is coming in. So this could hurt ASML's earnings over the next quarters. But for ASML, it is a high quality business. Also, Momo is having a promotion today. So if you open a new account and deposit $100, you get $20 worth of Nvidia shares. It's completely free. This is an affiliate link, so I'll make a small commission out of this one. If you guys are interested in opening a new brokerage account, then consider Momo. The link is in the description. The next stock that I'll be covering as well is United Health. So United Health year to date is down around 40%. It is currently trading at a 13 times of earnings. So for United Health, the TCs are as follows. So first of all, the margin compression is one that is overstated by the markets today. So the margin compression this year can easily be solved next year when they hike their prices for all these different premiums and products. So CEO Hemsley is likely understating their earnings this year as well to reset expectations for more upside potential. And that is what we saw with their earnings just a few months ago. Besides that, there are overstated risks in terms of its earnings. It's an industry-wide problem and not a company-specific one. So all the companies in the healthcare sector are suffering, not just United Health. So when that happens, what this means is that all the companies can pressure and increase prices together in unison. So it will incentivize all these companies to try and push for higher prices next year, which will help to benefit not just the other companies, but for United Health as well. So this will help to improve their margins next year, which is the main thesis for United Health. The next company that I'll be covering as well is Amazon. So Amazon is a Max 7 that is underperforming massively. It is currently up around 4% year to date, trading at a 35 times of earnings. So for Amazon, there's two TCs for the company. The first one is the margin expansion. So the company has been spending a lot of money on infrastructure as well as R&D over the past few years. So the company is continually suppressing its earnings by increasing R&D spend, to propel the company towards more growth so that the lifetime of the company is lengthened. But with Andy Jassy in charge, if the company is able to move slowly from growth towards profitability, you will likely see a lot more upside in terms of earnings as compared to the revenue of the company. So this is operating leverage that I'm speaking about for Amazon. I think the company is primed for margin expansion, especially with this CEO in charge. And besides that, Amazon is one of the largest beneficiary of this AI wave. So they're the largest cloud company in the entire world, and it has continued its operating leverage in this department. So you're seeing massive increase in terms of its margins over the past few quarters, and we can expect something similar as well in the future once all the infrastructure is built out. And besides that, retail and advertising are overlooked. These are two segments of Amazon's business that could bring in a lot more income over the next few years. So if you have to compare Amazon's margins for both the retail as well as advertising segment, they are significantly lower as compared to its competitors. Of course, Amazon is artificially pushing it down so that it can gain more market share. But once that market share gain slows, once the company prioritizes earnings, we could see a lot more upside in terms of margins in these two segments as well. As for Amazon, the risks are as follows. So first of all is your macro risk. So lower consumer spending will hurt Amazon's earnings, of course, and that was what we saw in 2022. Besides that, the capex spend is also increasing massively. So the capex spend is currently hurting their cash flow statement. And in the next few years, if Amazon can't keep up with its earnings growth, then we could see the bottom line getting hurt as well, with increased depreciation as well as amortization. Besides that, you have competition in the space. I think all these companies here, they are non-competitors as compared to Amazon in the US. Lastly, you have tariffs. I think the tariff fears are mostly over already. So that's why for Amazon, it is one of my highest conviction plays in my portfolio today. Next stock that I'll be covering as well is FICO. So FICO year to date is down around 30%. It is currently trading at a 55 times of earnings. This is actually a stock that I recently just added. So for FICO, the TCs are as follows. First of all, the FHFA trying to introduce competition in the space is something that is overstated by the market. So FICO still maintains a 90+% market share of the loan origination portion in the US, and there is no incentive for lenders to switch as well because they will end up taking on more risk if they were to switch. And besides that, your price increases for all these different FICO scores, they're simply passed on to the consumers and none of your lenders actually bear the cost. Besides that, your price increases will remain. So the company has said that they will be continually increasing the prices over the next few years. They see the justified value that the FICO score brings to be something similar to what S&P Global as well as Moody's charge, which is around 8 basis points, bringing the prices for FICO score to around $100 per score. So there is still massive runways for growth for the company if you were to see it that way. Besides that, we have rate cuts coming in as well. So this could be a tailwind in terms of volumes. Lastly, FICO's software is switching from on-premise to more of the cloud platform. So FICO is currently moving away from on-premise, and once we see that coming in, it could lead to a lot more margin expansion for the company because it will mean higher recurring revenues, it will mean higher lifetime value for all its customers. Because currently for the on-premise platform, what they're doing is they're charging a large upfront license cost, and the only recurring revenue that they're making is through maintenance. But this is nothing substantial as compared to the margins that they'll stand to gain if they switch all to cloud. Next company that I'll be covering as well is Copart. So Copart year to date is down around 13%. It is currently trading at a 32 times of earnings. So for Copart, here are two investment theses for the company. First of all is Copart's international expansion. So the company is venturing into other segments outside of the salvage car market. So they're venturing into heavy equipment, they're venturing into international sales as well. So currently around 25% of their revenues are used cars as well as international sales for salvage cars. So if they can continually increase their growth in all these different segments, if they can maintain the high market share in foreign markets, like for example in the UK, where they own around a 50% market share, this could be a tailwind for Copart. Besides that, your uninsured drivers is something that is cyclical. So it is currently rising due to macroeconomic issues, but once we see that coming down, this could be a tailwind for the company. Lastly, there's potential for upside for the company because when your interest rates are cut, it will reduce the borrowing costs for all your different cars. So when that happens, your used car demand will actually increase, which will help to improve volumes for Copart as well as higher income because your car prices will increase when there's more demand for it. The next stock that I'll be covering as well is UOB. So UOB is a stock that is down around 4% year to date. It is currently trading at around a 1.2 times price to book. So for UOB, the two investment theses are as follows. I'm planning to allocate some of my capital into UOB. I'm planning to switch from my REITs to my banks. So here are the investment theses for all these different banks. So first of all is that your risk-free rate in Singapore is already down. So compared to the US, where the risk-free rate is around 4.3%, in Singapore, the risk-free rate is currently around 1.2%. So this will protect the downside risk in earnings and will improve the volume growth due to lower expectations of decreasing rates. So when your consumers are borrowing money, if they're certain that your interest rates won't fall any further, then they're more incentivized to basically take up loans, which will help to improve volumes for all these different Singapore banks. Besides that, your Singapore banks are actually beating the S&P 500. So DBS, for example, has crushed the S&P 500 over the past 5 years. Same for UOB, I believe it's matching the market. So these are high quality companies in Singapore, with them beating the S&P 500, dividends included. So I'm planning for my Singapore positions to be equal weighted amongst the banks and the REITs, so that it is not affected by any interest rate decisions. I'm planning to trim some of my REITs and rotate them to the banks, in Singapore of course. So if you have to look at the valuation for OCBC as well as UOB, so OCBC is currently pricing in around a 4.8% growth in terms of its dividends. Over the next 5 years, UOB is pricing in around a 4.7% dividend growth over the next 5 years. So historically, the dividend growth has been around 8%. So putting in an 8% growth for these companies will make them extremely undervalued. So I view them as decently priced today, although I would like for their price to book to drop closer towards a 1. Last portion, I'll be covering some questions left in the comments. So the first one, it says, hey, what do you think about Duolingo stock right now? So Duolingo stock is a company that is speculative. It is a company trading at 100 times earnings. And for me, I'm not interested in a company like this simply because the valuation is too high and I don't use their products as well. So I know it's a stock that is talked about by Joseph Carlson. Bear in mind, he has a very small allocation into this stock. So I don't think it is anything substantial to him to put 2% of his portfolio into Duolingo. I think Duolingo is a decent company with massive growth, but of course we could see the growth declining, especially with the social media backlash that they're currently facing. And your AI revolution as well as improvements in terms of translation will decrease the need for learning of languages on this Duolingo app. So for me, this is a company that is highly speculative. I don't think it is a company that is interesting right now, so I will be avoiding this one. See you guys for another video.